And it's been a rocky ride for investors lately, with markets swinging on everything from inflation and interest rates to global tensions. It's getting harder for people to tune out the noise and stick to their financial plans. And this isn't just about short-term losses. It's testing long-term discipline and emotional resilience. Inflation's proving stubborn, central banks are keeping rates higher for longer, and uncertainty continues to ripple across the globe. That's leading many investors, even seasoned ones, to second-guess their strategies. I'm now joined by Brendan Caldwell, director at Caldwell Securities Ltd, to unpack this. Brendan, thank you for the time today.
Always great to be here, Melissa. You mentioned resilience, and it put me in mind of the Nova Scotia poet Alden Nolan, who said or wrote in one of his poems that this is a country where a man can die simply from being caught outside. We are a cold country, a northern country, a large country, a wild country, and toughness for us is not about the damage that we can inflict on other people, but what we can withstand. I wrote something about that in the Post and the Globe earlier this year, just about Canadian values and how resilience is really our greatest strength. So when it comes to markets, I think it'll be interesting to see individually as well as collectively what resilience looks like.
Well, and in periods of heightened volatility, how can clients avoid panic-driven decisions like locking in losses or abandoning long-term plans?
Well, I think the first things first is to write down your long-term plans, what it is that you want to accomplish in life. Like actually sit down. You can do it with a professional. People in my trade can help with that, to help unpack what your hopes and dreams are. But if you're talking more specific about a particular investment, the question is, what does that particular investment, that stock, that mutual fund, that the exchange traded fund, the ETF, what did you want it to do? Why did you buy it? What were you hoping that would happen that would cause this investment to benefit? And if your initial thesis is still intact, if you thought, for example, you would buy this particular stock because it would benefit because when interest rates went down or went up or what have you, and if the market did what you thought it would do and the stock responded the way you thought it would, well, very well. If it didn't respond the way you thought it would, you're either going to need a new thesis from scratch or it's time to get rid of the investment. There is a tremendous benefit to being very clinical and unemotional about any particular investment when it comes to the longer term plan, or even when it comes to a shorter term stock investment, just to think it out, to write down the reasons and to be clear on them in one's own mind, I think will stand a person in good stead.
And what's your perspective on maintaining asset allocation discipline during market drawdowns? Should clients rebalance more aggressively or stay the course?
It's very hard to stay in when the markets are down, but it's also equally hard to leave when markets are strong. I think that the S&P and the NASDAQ index in the US both hit all-time highs today. I believe that's the case. So it's very hard to leave a raging bull market behind. And yet, for those that need money in 3 months or 6 months, that know that they're going to have a house closing in October or that there's going to be a significant change in January for them, I think it might be worthwhile at this point to take some money off the table. Not because I think the market's going down necessarily, but again, playing chicken with the market, as in any game of chicken, for what you may stand to win, the exhilaration of having won the game, of having beat the market in this case, may not be worth the price of getting smacked if the market does pull back sometime in the autumn for reasons that might be foreseeable or for reasons that aren't. So I think one needs to make one's buy and sell decisions, like with an individual stock decision, a little clinically based on what your needs are, because all money eventually is meant to be spent, either now or in the future. And if you know you're going to need the money in the foreseeable future, maybe with the markets at all-time highs, you raise a little bit of cash right here.
And how is investor psychology changing the current macro environment compared to previous cycles like 2008 or 2020?
Well, There's nothing new under the sun, as was written in the prophets. There's nothing new under the sun, and at the moment, the current craze is AI, artificial intelligence, and stocks related to that. In the past, it had been crypto, or it had been cannabis, or had it been the interwebs. Yes, I know that's not how it's said, but there's always a new technology that's on the verge of changing everything, going right back to the railroads. But even going right back to the railroads, what we've seen is that there is always overbuilding, over expectation, over hype at the beginning. And the stocks, be they railroad stocks or tech stocks in the late 90s, or cannabis stocks 10 years ago, or Bitcoin stocks 5 years ago, tend to get ahead of themselves. And then there is the inevitable correction. And the investors were right. Things did change. It remains to be seen how artificial intelligence changes the world. You're still a real person, right, Theresa? I'm not talking to an avatar.
Maybe.
Yeah, there you go. So it remains to be seen, but I do think that having some participation in the hot new thing is not a terrible thing. How we tend to do it is in the picks and shovels. Take it with cryptocurrency. I don't own any Bitcoin myself, but we have a really good investment in a private company here in Canada that is the only regulated crypto custodian in the country, a company called Tetra Trust. So that, I don't know if Bitcoin, Ethereum, or some other stable coin ends up being the dominant currency in this environment. But if I can provide the institutions, the technology that helps these things survive, it'll probably work out all right.
And with interest rates staying higher for longer, what are some portfolio shifts you think make sense but aren't obvious to average investors?
Well, yes, interest rates are high relative to where they were for, well, the 20 years really leading up to the COVID crisis, and a couple of years beyond that. So from the beginning of the century, really, to 2022, interest rates are high, but in historical standards, they're actually quite low. Now, it remains to be seen what happens, particularly here in Canada, where I think we may be in an undeclared recession. It might be that the economy has actually slowed that much in this country. So, and in the US, I think it remains to be seen. There's some big financial numbers coming out this week. The US Federal Reserve is going to make its non-decision on interest rates. It's going to keep them flat. There's not going to change it, no matter how much pressure President Trump, or maybe even because of how much pressure President Trump is putting on the US Federal Reserve. Interest rates there are not going to change anytime particularly soon, and probably not during the Powell incumbency as the chair of the US Federal Reserve, as an aside. So, but let's say you thought interest rates were actually going to come down. So what are some stocks that could benefit? There's a Canadian company called Real Matters, which is in the most boringest business on the planet of Earth. It does the appraisals and the title and settlement for U.S. consumers buying and selling houses, and it tends to do extraordinarily well when interest rates come down. So, there are stocks like that if you thought interest rates were going to come lower, there would be some leverage to that. Bank stocks, financial services also tend to do well in that environment.
And do you believe that today's volatility presents more of a risk or an opportunity for long-term investors?
Both. It's two-sided. It's a risk if, as we talked about at the beginning, people are emotional about their investments. They're not clear on why they're making their investments. They're buying the hot new thing. Today it's AI because it's the hot new thing, and putting all their eggs in that particular basket. But I think it's a wonderful opportunity, particularly for newer investors starting out, where they can put a little bit of money aside. And we've talked about this, I don't know how many times, Theresa, just that they put a little bit of money aside every month. Volatility is their friend, because they're buying more when things are cheaper, less when it's more expensive. And the effect of dollar cost averaging allows them to get into the market over time, so that if there's a crash or a this or a that, next time, it doesn't matter. They're just buying more all the way along.
Well, Brendan, thank you so much for the time today.
Thank you, Theresa.